Hello and welcome everyone. Uh, today's lecture on UK taxation for business and individuals. My name is Yasir, and I'm your tutor for today's session. Uh, if anyone is there, can you see my screen and can you hear my voice clearly? Please do let me know if there is an issue. So let's get started. We will discuss in this lecture session, we will discuss an important aspect of taxation management, taxation planning measures to minimize or defer tax liabilities. So taxation planning plays an important role in minimizing tax liabilities and optimizing tax outcomes for businesses and individuals. Recap. Uh, In our previous lecture, we discussed professional behavior, professional competency, and due care, competency and capability, confidentiality, integrity, objectivity, parent, subsidiary, associate, and simple. Today, we will discuss different type of investment, other expenditures that may result in a reduction in tax liabilities for individuals and both incorporated and unincorporated business organizations. Be able to advise on the appropriateness of each of these types, understanding of legitimate tax planning, mitigation of tax based on numerical analysis and reasoned arguments, uh, assessment of ethical and professional issues, current issues in taxation in the UK. So first of all, so let's start by discussing the normal income tax rates in the UK for individuals' income taxes imposed at different rates depending on their income level. The basic rate applies to taxable income between £1 and 37,500 at a rate of 20%. Then the higher rate of applies to income between 37,500 and 150,000 pound, as you can see here, uh, uh, which is taxed at 40%, while the additional rate applies to income over 150,000 pound at 45%. In addition to these normal rates, there are specific rates for dividends. Dividends are taxed at 7.5% for tax rate taxpayers, 32.5% for higher rate taxpayers, and 38.1% for additional rate taxpayers. So there is also a dividend nil rate band of 2,000 pound. So here we will discuss some important allowance and contributions as well. Uh, the personal allowance, which is the amount of income you can earn tax-free, is 12,500 pound. However, this allowance may be reduced for individuals with adjusted net income over 100,000 pound, and it is completely phased out for those with adjusted net income over 125,000 pounds. Another important consideration is the resident status, which determines an individual's tax liability in the UK. Your resident status is determined by the number of days you spend in the UK and your ties to the country. Being residents or non-residents can have significant implications for your tax obligations. Resident status refers to whether an individual is considered a resident or non-resident for tax purpose in the UK. The status depends on the number of days spent in the UK and the individual's ties to the country. uh, if an individual spent less than if 16 days in UK, they are automatically considered non-resident. Spending between 16 and 45 days in the UK may not automatically make someone a resident, but uh, having certain ties to the UK could change that. Individuals who spent 183 days or more in the UK are automatically considered residents. The number of UK ties also influences resident status. For example, having 4 or more UK ties makes an individual a resident. So, lastly, we have the child benefit income tax change, which applies to the individual, which income range 50,000 pound and 60,000 pound. In this income range, a change of 1% of the amount of child benefit received is imposed for every 100 pound of income over 50,000 pound. Any questions so far? If anyone's there. Uh, Now, car benefits percentage, car fuel benefits, company van benefits, and ISA or individual saving accounts property income. Car, the relevant base level of CO emissions is 95 gram per kilometer. So the percentage rate applies to petrol cars and diesel cars meeting the RDE2 standards and CO emission up to their levels. So 50 grams per kilometer or less, 16%, 50 gram and up to 75 grams per kilometer, 19%. 76 to 94 grams, 22%, 95 grams. Your example here, 23% tax charge. So car fuel benefits. The base value used to calculate your car fuel benefit is 24,100 pounds. The figure does not directly translate to the tax you pay. Uh, if your company provides a van, two separate categories might apply. A company van benefit scale changes. This is a set amount in the case of 3,430 pounds. Van fuel benefit similar to car fuel benefit. There is a separate charge for private van fuel usage, which is 655 pounds. In ISA, individual saving accounts are efficient saving account. The total amount you can invest across all your ISA in a tax year has a limit. Currently, the overall investment limit is set at 20,000 pounds. Any money you invest within this limit grown tax-free, meaning you won't pay income tax or interest or capital gain tax. Finally, you can see here property tax. If you own a resident property and incur financing costs like mortgage interest, you might be eligible for tax relief. So in this scenario, 75% of your finance cost can be deducted from your rental income before calculating tax. This is referred to as the basic rate restrictions because it applies to the basic income tax rate. Any questions so far? Next one is pension scheme limit. The annual allowance for pension contribution is set at 40,000 pounds with premium allowances of 10,000 pounds. However, there is an income limit of 150,000 pounds to consider. It's important to note that the maximum contribution eligible for tax relief without any earning is capped at 3,600 pounds. So now we will talk about uh, approved mileage allowance for cars for business related travel. There is a mileage allowance set by HMRC for the first 10,000 miles. The rate is 45p per miles, and for mileage exceeding 10,000 miles, the rate reduces to 25p per miles. Moving on onto capital allowances, which are deductions businesses can claim for certain types of expenditures. For plant and machinery, the main pool allowance is 18%, while the special rate pool allowance is 6%. When it comes to motor car, the rates vary based on their CO emissions. New cars with CO emission up to 50 gram per kilometer qualify for 100% allowance. Cars emitting between 51 and 110 gram per kilometer receive an 18% allowance, which while those emitting over 110 gram per kilometer are eligible for a 6% allowance. Any questions so far? Next is AIA, or annual investment allowance. This allowance allows businesses to deduct the full value of qualifying capital expenditures from their taxable profits. So up to certain limits, currently the rate of allowance is 100%, and the expenditures limit stands at £100,000. Corporation tax, which is the tax imposed on the profit of limited companies for the financial years 2017, 18, and 19. The corporation tax rates has remained constant or at 19%. However, it is important to note that there's a profit threshold of £150,000, meaning companies with profit below this threshold are eligible for a lower tax rate. Uh, Now, value-added tax, a consumption tax imposed or levied on the value added to goods and services at each stage of productions or distributions. Standard rate in the UK is 20%. Businesses must register for VAT if their taxable turnover exceed the registration limit of £85,000, uh, and may deregister if their turnover falls below £80,000. Any questions so far? Now, inheritance tax, which is payable on the estate of a deceased person. The nil rate band, which is the amount that can be passed on tax-free, is £325,000. Additionally, there is a residence nil rate band of £150,000, which applies when a property is passed on to direct descendants. So the rate of tax on the excess over a nil rate band is 40%, and the lifetime transfer, it's also 40%. Capital gain tax, which is the tax of the profit made when you sell or dispose of an asset that has increased its value. Currently, there are two rates for capital gain tax: a lower rate and higher rate. The lower rate applies to basic rate taxpayers, while the higher rate of additional taxpayers. Uh, while the higher rate is for additional rate taxpayer, the annual exempt amount, which is the threshold before capital gain tax is applied, is £12,000. However, entrepreneurs relief and investor reliefs offer a lower rate of 10% and a lifetime limit on qualifying gains. Moving on to national insurance contributions, these are payment made by employers and employers to fund various state benefits for employees. National insurance contributions are divided into different classes based on income levels. Class 1 insurance are applicable to employees with rate ranging from nil to 12% for income between £8,633 and £50,000 and 2% for income above 50,001. For employees, class 1 NIC are 13.8 with an employment allowance is £3,000 available to reduce the liability. Additionally, class 2 and class 4 national insurance contribution apply to self-employed individuals. Uh, Now, interest rates which play a role in tax payments. So the official rate of interest used in various tax calculation is currently 2.50%. If tax is underpaid, HMRC charge interest at a rate of 3.25%, while overpaid tax earns interest at a rate of 0.50%. So last one is standard penalties for errors uh, in tax filing. These penalties vary depending on the taxpayer's behavior, ranging from careless mistakes, penalties, or deliberate and concealed action. So the maximum penalty can be as high as 100% of the tax due for deliberate and concealed behavior, while the minimum penalty for unprompted disclosure is 30% and prompted disclosure it's 50%. So evaluate type of investment and expenditure resulting in a reduction in tax liabilities. Since most companies pay tax, the impact of corporation tax must be considered in any investments. For example, when evaluating investment or expenditure, it is essential to consider the impact of corporation tax, understanding how additional income and cost affect tax liabilities, as well as utilizing tax relief mechanisms such as writing down allowances can help companies make informed decisions to minimize their tax liabilities and maximize their returns. Any questions so far? Okay, so impact of taxation on the discount rate when calculating the weighted average cost of capital, it is important to consider the cost of debt as a post-tax figure. This means that the cost of debt has been adjusted to account for the tax relief on interest payments by incorporating this adjusted figure into the VACC or average cost of capital calculation. We ensure that our discount rate accurately affects the tax implications of financing our investments. So when we talk about impact of taxation on project cash flows, taxation affect investment appraisal in several ways. Firstly, project cash flows are subject to taxation, which can influence the overall profitability of the project. Additionally, organizations can benefit from claiming capital allowances, such as writing down allowances, which provide tax relief on qualifying assets. So these allowances effectively reduce the amount of tax that organizations are required to pay, thereby affecting the cash flows generated by the investment. However, it is important to note that the effects of taxations can be complex and influenced by various factors. These factors include taxable profit, tax rates, accounting periods, tax payments, dates, capital losses, and available losses for set-off. So while these factors play a significant role in determining the tax implications of an investment, They are often simplified or ignored for the purposes of net present value or NPV investment appraisals. When conducting investment appraisal, it is important to consider the impact of taxation on both the discount rate and in the VACC calculations and the project cash flow. So by accounting for these tax implications, organizations can make more informed decisions about their investments and ensure that they accurately assess their profitability. Any questions so far? Okay, capital allowances or writing down allowances. In tax accounting, businesses cannot deduct the cost of assets from their profit or as depreciation as they do in financial accounting. Instead, they can claim capital allowances or WDA, which allows them to deduct the cost of assets from their taxable profits. Uh, WDARs are calculated based on the written down value of the assets. This value can be calculated either on a reducing balances or strategic uh, straight line basis. So depending on the specific circumstances outlined in the tax regulations. The total WDA claimed over the life of an asset should generally equate to its fall in value over the period, which means it reflects the cost of the assets less any scrap proceeds. Businesses should aim to claim WDAR early as possible to maximize their tax relief and reduce their taxable profits. WDA are typically claimed for every year of ownership of the assets, except for the year of disposal. This means that businesses can benefit from tax relief on the assets depreciation each year until it's sold or scrapped. So in the year of sales scrap, a balancing allowances or balancing charge may arise. A balancing allowances represents additional tax relief if the asset's written down value exceeds its disposal value, while a balancing charge represents additional taxable income if the disposal value exceeds the written down value. Any questions so far? So in tax accounting, when business purchase assets, they often claim capital allowances for or written down allowances to deduct the cost of these assets, as you can see from their taxable profit over time. So uh, as you can see here, original cost of tax, cumulative capital allowances claim written down value for the assets, disposal value of the assets. So financial management terms continue their internationalizations. The term capital allowances or writing down allowance in some being replaced by tax allowance depreciation. So all three terms can be used interchangeably. Any questions so far, if anyone's there? So the timing of asset purchase, assets are assumed to be bought at this could be the very end of accounting period, most likely in end of December or at the start of another uh, January. So there is no distinctions between these days for this counting, but there is a for tax. Assets bought off at the end of accounting period, calculation would be like this. Asset purchase 31st of December, then WDA claimed on 1st to January till 31st of December, then WDA claimed uh, against profit, and then finally 31st December asset sales. So Laying out long net present value. Uh, in investment appraisal, we consider the impact of taxation over several years. Uh, Net trading revenue, this indicate all the money coming from trading activities, such as if you see here net trading revenue. So this indicates all the money coming out coming in from trading activities such as sales revenue minus operating expenses. Tax payable, we calculate the tax payable based on the net trading revenue. This tax payment is usually delayed by 1 year. So in the first year, we don't pay tax on the revenue earned. Instead, it is paid in the following year. So investment represent any additional investment made in the business, such as purchasing new equipment or expanding. Scrap value, residual value. This is the value of asset at the end of the useful life. Tax relief and working capital flows. Tax relief, writing down allowances, provide tax relief on capital investments. Working capital flows or the in fluctuations in cash flow due to change in working capital, such as inventory levels or accounts receivable. Here, pensions and other tax efficient, investment uh, products. So pensions, basically contributing to a pension scheme. When you contribute money to a pension scheme, you often receive tax relief on those contributions. So this means that the government add money to your pension pot, making it as a tax efficient way to save for retirement. Any questions so far, if anyone's there? Okay, so type of trading loss relief. Loss relief against the total profit before against future total profit, current AP and carry back 12. So loss relief against total profit before QCD, when businesses uh, incurs losses in a particular accounting period, it can sometimes use those losses to reduce its total profit for tax purposes. Before taking in accounting, account qualifying charitable donations or QCDs, this means that if a business has made losses in 1 year, it can offset those losses against the profit in other years, reducing its overall tax liability. Loss relief against future total profits. Alternatively, businesses can carry forward their trading losses and use them to offset against their future loss total profit. This means that if a business makes a profit in only year but expect to make profits in the future, it can carry forward those losses and deduct them from its future profit, reducing in tax bill in those years. These two types of trading losses relief provide businesses with flexibility in managing their tax liabilities and help to support them during periods of financial difficulty. So it is also important for businesses to understand and utilize these reliefs effectively to optimize their tax positions and support their long-term financial health. Relief against total profit before QCD. Claim against total profit before QCD must claim against current AP first before claim against previous 12-year claims equal to optional. So if business has total before QCD of 56,000 pound, if you see here, but it occurs trading losses of 60,000 pound, if the business decides to make a claim 56,000 of 56,000 pound of the loss will be used to offset the 56,000 pound of profits. Reducing the taxable profit to zero, the remaining 4,000 pound of the losses cannot be used as there are no profit left to offset considerations for QCD. If there are no profit remaining after offsetting the losses, any QCD or qualifying charitable donations become surplus and cannot be used for relief. So essentially, resulting in wasted relief, understanding how to claim relief against total profit before qualifying charitable donations. Uh, can help businesses effectively manage their tax liabilities and optimize their financial positions. Any questions so far? Carry forward relief. When a business experiences trading loss, these losses are automatically carried forward to future years under certain conditions. If no claim for relief have been made in the current year or carried back to previous years, or if there are still losses remaining after any claim for relief have been made in the current year and carried back to previous years. Uh, Treatment of trading losses carried forward depend on when the losses arose pre 1st April 2017. If you see here, these losses are automatically carried forward against the first available future trading profit from the same trade. They cannot be used against any other type of profits. Post 1st April 2017, businesses have more flexibility. They can choose how much, if any, of the losses to offset against total profits in the current year and how much to carry forward to future periods. Corporation tax loss pro forma. If you look, we are looking at pro forma that outlines the calculation of total profit and loss relief for 3 consecutive years ending on December 31st, 2019, 20, and 21. Pro forma over the pro forma shows the total profit for each years. If you see here, you know, which includes trading income, other income, and net chargeable gain. So if then deducts loss relief from the total profit, which consists of current year loss relief, carry back loss relief, and carry forward loss relief. After deducting loss relief, the pro forma calculates the total taxable profit for each year. Uh, Now we will talk about losses incurred in the year ended December 31st, 2020 can be offset against profit in subsequent years. In this pro forma, the losses 2020 can be set off against different categories or of profit to reduce the overall tax liability. The loss can be offset against the total profit before qualifying charitable donations of the current accounting period. So this means that the loss from 2020 can be deducted from the profit earned in the current accounting period. So secondly, the loss can be set off against the total profit before QCD of the previous 12 months. This allows businesses to use the loss from 2020 to reduce profits earned in the preceding year. Additionally, the loss can be carried forward and set off against future total profit. So this means that if there are no immediate profit against which to offset the loss, it can be carried forward and used in subsequent year when profit are earned. short previous accounting period. Uh, when a company makes a loss in its accounting period, it is often possible to carry that loss back to offset against profit from a previous period. This can help reduce the overall tax burden. Usually, this means that if a company makes a loss in 1 year, it can deduct that loss from the profit it made in the previous year. However, there's a twist when the previous accounting period is shorter than 12 months. So here you can see an example. December 31st, uh, a company has a loss in the last 12 months leading up to December 31st, 20, but the previous accounting periods were only 8 months leading up to December 31st, 2019, and 12 months leading up to April 30, 2019. Now, in this case, the company can carry the loss back against two things. First, all of the total profit for the 8 months up to December 31st, 2019. And secondly, 4 out of the 12 total profit of the year ending April 30, 2019. So even though the previous accounting period isn't full 12 months, the company can still use it to offset some of the losses from the most recent period. Factors to be considered when choosing loss relief. The two main considerations, when a company does the company want relief, earliest relief, in which case a currently and carry back claim would be preferred. So does the company want to obtain the highest tax relief, in which case a current and carry back claim would also be preferred, as UK corporation rates are falling. Capital losses automatically relieved against current period chargeable. Any excess loss carried forward and relieved against gains in the future. No carryback relief available, can only be set off against chargeable gains, not income. So when a company, a person or a company sells an assets or less for less than what they paid for it, resulting in a loss, that's what we will call a capital loss. So these losses are handled in a specific way in the tax system. First, capital losses are automatically relieved against any current period chargeable gains. So this means that if you have capital gains in the same tax period, you can use your capital losses to reduce the amount of tax you owe on those gains. If you have more capital losses than gains in a given period, the excess loss is carried forward to future periods. This means you can use it to reduce any future capital gains you might make, it like carrying over debt to be paid off later. Unlike some other type of losses, capital losses cannot be carried back to offset gains from previous periods. They can only be used against future gains. So this is an important distinctions to keep in mind. So also it is worth noting that capital losses can only be set off against chargeable gains, not against regular income. So if you have a capital loss, you can't use it to reduce the amount of income tax you owe, only the tax on gains from selling assets. Research and development taxes. Uh, Research and development taxes can be a game changers for small and medium entrepreneurship, offering substantial tax reliefs for their innovating endeavor. By understanding the qualifying criteria and the potential benefit, SMEs can leverage research and development tax credits to fuel their growth and development. Personal service companies, IR35. Personal services companies exactly is a personal service company, or PSC for short. Well, it is typically a company with just one shareholder who use it to provide their services to clients. So essentially, it is a way for individuals to work for themselves through their own company rather than as an employee of another company. Personal service companies can offer certain tax advantages. It is important to ensure that they are being used legitimately and not to avoid tax obligations. So IR35 is designed to maintain fairness and ensures that everyone pays their fair share of taxes. So basically, IR35 essentially look at the nature of the relationship between the individuals and the clients. So they are providing services to through the PSC. If it is deemed that the individual is acting more like an employee than a genuine independent contractor, then IR35 may apply and the individual may be required to pay tax and national insurance contributions as if they were an employee. Now we will discuss relevant engagements. We are referring to contracts between the PSC and the client. So these are contracts that would have likely been considered contracts of employment if the PSC or personal service company was not involved. In other words, if the worker was providing their services directly to the client without the immediately of the PSE, it would likely be an employment situations. So this is the entity or individuals that requires the service being provided. They engaged with the PSC to obtain these services. We have the owner, if we have the owner of the PSC who is also referred to and the shareholders, this individual typically owner and operates the PSC and is the one of providing the services to the clients. So then there is the worker who is essentially the same person as the shareholder in the context. They are the one actually performing the services for the client. So when IR35 comes into play, it is looking for these relevant engagements, those contracts between the PSC and the client. It is assessing whether these engagement would have been considered employment contracts if the PSC was not involved. Uh, if IR35 determines that the nature of these engagement in such that they resemble employment relationships, then it may apply. So this means that tax and national insurance contribution could be due as if the individuals was an employee rather than operating through a PSC. So it is essential for those operating through personal services companies to carefully consider the nature of their engagement with clients and ensure compliance with IR35 regulations. Uh, Next is evaluate the mitigation of tax for individuals and businesses. In tax planning, it is important to adhere to the principle of professional competences and due care. As a tax advisor, you are responsible for providing advice that is not only effective but also legal. So when it comes to mitigating tax for individuals and businesses, it is important to understand the distinctions between tax avoidance and tax evasion. So tax avoidance involves utilizing legal means to minimize tax liabilities, while tax evasion involves illegal activities such as withholding relevant information or providing false information to tax authorities. So again, when it comes to tax evasion, it is important to understand the significant impact it can have to the fundamental principle or integrity uh, and professional behavior. Tax evasion involves intentionally evading or attempting to evade paying taxes, which undermines the integrity of the tax systems. Not only is tax evasion ethically wrong, but it can also lead to serious legal consequences. Tax evasion may result criminal charge under both tax law and money laundering legislations. So, as a tax advisor, you have certain responsibilities when dealing with clients who may be involved in tax evasion. Tax evasion poses a threat to the integrity of the tax system and can result in severe legal repercussions. As a tax advisor, it is your responsibility to uphold professional standards, advise client on proper disclosure to HMRC, and ensure they understand the seriousness of tax offenses. Tax avoidance scheme, particularly focusing on both direct taxes and value-added tax avoidance schemes. So, when we discuss direct taxes, we are referring to taxes like income tax, national insurance contributions, capital gain, corporation tax, inheritance tax, and stamp taxes. Promotes of tax avoidance schemes related to these direct taxes have certain obligations. So these promoters are required to disclose details of their schemes if the main benefit is to help uh, someone gain an advantage in terms of tax. This advantage could be relief or increased relief from tax repayment or increased repayment of tax or avoiding or reducing a change to tax. If a promoter or any persons fails to comply with these disclosures obligations, they could face penalties. Initially, the penalty may not exceed £5,000. If the failures continues after the penalty, additional penalties may be imposed, not exceeding 6,600 pounds for each day the failure continues. Then we talk about VAT avoidance schemes. Businesses using VAT avoidance schemes also have a disclosure requirements. Some VAT avoidance schemes, known as notifiable schemes, are placed on statutory registers. If a business fails to notify HM Revenue and Customs about the use of designated scheme, the penalty could be 15% of the VAT saving resulting from the scheme. For using other avoidance arrangement, the penalty is fixed amount of £5,000. Any questions so far, if anyone's there? So serial tax avoidance, if a taxpayer used more than one tax avoidance scheme that has been defeated on or after 6 April 2017, HMRC may classify them as a serial tax avoider, as a defeated scheme is one of which either the taxpayer has reached an agreement with the HMRC so that the expected tax advantage is not available, or HMRC has obtained a favorable court or tribunal ruling about the assessment of the scheme. When a HMRC identifies a tax payer as a serial tax avoider, they issue a serial tax avoidance warning notice that remains in effect for 5 years. So this notice requires the taxpayer to provide additional information to HMRC about their tax affairs annually, so including details about their use of tax avoidance schemes. There are several sanctions that may be imposed on serial avoidance, may be applied if penalties may be applied if the taxpayer enters into further tax avoidance scheme during the notice period. So these penalties increases with the number of schemes entered into. Serial tax avoidance may be publicly named as such by HMRC, which can have reputational consequences. Evaluate ethical and professional issues arising from giving of tax planning avoidance, ethics, tax avoidance, speak. This is an important topic because tax planning can have significant implications for individuals and businesses, and it's important to approaches it with integrity and professionalism. So ethical are fundamental principle that guide and our behavior and disclosure make decision making. When it comes to tax planning, there are several ethical considerations to keep in mind. One key principle is the disclosure of information. As tax advisor, we have a duty to ensure that our clients provide accurate and complete information to tax authorities. This helps maintain transparency and integrity in the tax system. When we talk about tax avoidance scheme, there are different type of tax avoidance schemes, including direct tax avoidance schemes and VAT avoidance scheme. These schemes may involve exploiting loopholes or legal gray area in tax laws to minimize tax liabilities. While tax avoidance is legal, it arises ethical questions about fairness and compliance with the spirit of tax laws. As we discussed, serial tax avoidance and also journal anti-abuse regulation. In the context of tax planning, it is essential to consider the GAAR, journal anti-abuse rules, which targets abusive tax arrangements, aims to prevent taxpayers from exploiting tax laws in way that were not intended by lawmakers. Any questions so far, if anyone's there? So again, ethics and tax avoidance schemes, ethics and tax avoidance we just discussed. Fundamental ethical principles. Accountant must be vigilant and aware of any threats to their ethical behaviors. This include threats them that may arise from their role as a member in practice or members in business. For members in practice, threats can come from various sources such as self-interest. So this means accountants should avoid situations where they have a financial interest in their clients, or where they depend heavily on the client fees for income. One significant threat is a self-review. This occurs when an individual discovers a significant errors while reviewing their own work. It is important to remain vigilant to avoid overlooking mistake or biases uh, in one's own work. Another potential threat arises when reporting on system after being involved is designing them. In such cases, there may be temptations to downplay or overlook shortcoming in the design. compromising objectivity in reporting, preparing the data used in reports that you are required to check possess yet another threat. So when individuals are responsible for both preparing and reviewing data, there is a risk of overlooking errors or misinterpretations due to familiarity with the data. So lastly, having a financial interest in the employer can create conflict of interest, undermining objectivity and professional judgments. Uh, when we talk about our attention to members in businesses, one common threat they face is being asked to review data or justify, evaluate decisions in which they have been directly involved. So this scenario can compromise objectively and independence, as individuals may be inclined to defend their own actions or decisions. Another common threat is familiarity, intimidations, and advocacy. Having a close familiarity threat is when former partners of the accounting firm now holds a senior position at a client firm. This situation may create conflicts of interest or bases in decision making. Accounting, accepting significant gifts or preferential treatment from a client can also pose a threat to ethical behavior. So this could influence the accountant's judgment and create perceptions of bias or favoritism. Intimidations threat can arise when accountants feel uh, uh, pressured or threatened in their professional engagement. For example, a member in practice may face intimidation if they receive threats of dismissal, replacements, or litigations in connections with an engagement. So this could occur if a client is dissatisfied with the accountant's work or if there are disagreements about financial reporting. So last one is advocacy threat. This occurs when acting on behalf of an audit client involved in a dispute with a third party. In such situation, there's a risk of compromising objectivity and independence by advocating for the client interest over those of the third party. Safeguards. We're talking about safeguards. Example of safeguards in the work environment. Development of leadership culture that stresses importance of fundamental principle, policies and procedure for qualify, control, and compliance with fundamental principles. This is for members who in a practice. Policies that identify threats, evaluate their significant, and identify safeguard procedures and prevent non-team members influencing on engagement, communications of policies and procedures to stop. So for our members in business, the employer structures and system for corporate governments, the employees' own ethical codes and disciplinary processes and training communications about them. Internal control, qualify, performance monitoring system, recruitment, selections, appraisal, promotions, training, and reward. Leaders all that communicate and model ethical behavior and expectations, policies and procedures supporting employees in raising ethical concerns, uh, forums for discussing ethical issues at work, for example, an ethics committee. So review current issues in taxations. Uh, like here is the example of a company, Limar, the managing director and majority shareholders of REP Limited sent an email about some important decisions. First, he talked about possibly investing in a new company called J Limited. This new company will start making computer parts in place called Garia from April 2021. Limar is thinking about investing 30% of REP Limited's money in J Limited, but he is worried it might be risky. He is considering investing only 20% instead. J Limited is expected to make a profit in the year ending March 2022, but it might also lose money in the future. Lamar needs advice about when J Limited should be based and how tax might affect its profit. So, so Limar mentioned REP Limited wanting to buy a new building for £200,000 plus 20% VAT. Uh, yeah, VAT REP Limited plans to rent out the buildings to stop for 20% for 20 years. Limar want to know if REP Limited can get back the VAT it paid when buying the building. Lastly, Limar talk about giving 220,000 shares of REP Limited to here 20,000 shares uh, of REP Limited to trust for his niece and nephews. So even though he will still own most of the company's shares, he's worried about having to pay inheritance tax if he goes through with the gift. He mentioned giving money to family members in the past without any tax issues. Uh, so what required from you as a student of this course meeting notes of the discussion with Limar, knowledge obtained from advising other clients. Your company have helped several clients with businesses operating and permanent establishments in different countries, including one in Garia. Your experience with these clients gives you insight into international business operating tax implications and regulatory requirements. So this knowledge can be beneficial for REP Limited, potential investment in J Limited, especially regarding operations in Garia. Investment in J Limited, residency of J Limited, it is essential to consider where J Limited will be based as its affect tax obligations. If J Limited is based in the UK, it will pay UK corporation taxes on worldwide profit, but if it is in Garia, it will pay 13%. 13%. So business tax. So this impact or repeat limited tax liability and relief if J Limited faces losses in Garia. Uh, Elections to exempt J Limited overseas profit from UK tax. If J chooses this, it won't pay UK tax on its overseas profit, but it might affect tax credit and other reliefs for REP Limiteds. You can also discuss the implications future to help you make an information decisions controlled foreign company or CFC rules. These rules aim to prevent UK companies from avoiding taxes by moving profit to low tax countries. If J Limited is in Garia, no CFC charges will apply, but it's crucial to understand these rules and their implications. C is purchases of investment property. When REP Limited buys the property, it will pay VAT, but it may possible to recover this VAT. So you can also discuss the process for VAT recovery and may consideration Lamar should be aware of. And then finally, a D proposed gift of shares to trust on November 1st, 2020. So Lamar plans to give shares to a trust which may trigger inheritance tax. You have to calculate the potential inheritance tax liability based on Lamar's shareholding and shares values. Lamar's ownership percentage and the value of shares will affect the inheritance tax calculations. That's it for today. So here are some references for and websites for further reading. So if there is any questions, concerns, or issues, you can drop me an email at yasir@ukversity.co.uk. And thank you very much, guys, for joining me today. And have a good weekend and bye for now.